Rob, take it away.
Okay. Well, thanks everyone for joining the Zoom. Hopefully this will be a useful session, and I'm hoping that everybody is doing as best they can in these difficult times. I just want to introduce Rob Stevens, who's here with us today. So I've known Rob for a long time. He's had go-to-market sales and marketing leadership roles at probably more than a half dozen VC-backed companies, including 2 of ours in our portfolio. And he's also been had roles at startups that had to navigate relatively successfully through 2 different economic crises in the past. So the first was a company called Free Markets, which was a B2B auction company that he joined in 1996 and faced the bursting of the internet bubble. And then the second was Kiva Systems, the warehouse robotics company that was acquired by Amazon, which Rob joined in 2005, and obviously had to help them manage through the recession in 2008. And, obviously, no, you can't say that this situation is the same, but there's certainly some similarities and some learnings from managing through periods of crisis and talking to customers from a B2B standpoint during those times. And so thought it'd be a great discussion. And thanks, Rob, for joining us today.
My pleasure. Nice to meet everybody. Yeah, so we've got a bunch of questions. Rob gave my quick background. Yeah, I've been in a couple of the companies, GrabCAD, Tive, Backupify here in Boston. Fortunately, none of them went through a recession, so probably less directly relevant to today's conversation.
Yeah, but
they had their own. They all had ups and downs, so there's lessons to be learned from all of them.
Yeah, that's right.
But I will say that probably the most challenging one, selling capital equipment to retailers in 2008 was a challenge. We'll touch on that.
Yeah. So maybe to kick it off, let's go with, there was a question about what's probably the most acute situation. So, if you're in a startup or company that is in an industry that is particularly impacted by the crisis, food, hospitality, recruiting, just how do you think about, what your activities are at this time?
Yeah, so I'll be careful through all of this, and I say this to everyone I meet with, and I do some consulting and some advisory work, and I always say, look, treat advice from people like me with a little bit of caution, right? Because people have their own experience, every company is different, every situation is different. And so I'll try to focus on the questions to ask and not the answers to give necessarily, because your mileage will vary. But I think, and I've got I'm an angel investor and I've been doing consulting work, so I've been involved in a bunch of companies that are going through it right now. And based on that and based on my experience with other companies, I'd say a couple things. So, everyone's in it. And first thing is to think about segmentation. So when you think about what markets you're in, it depends on where you are in the circle, right? So in the very beginning, often startups are serving several markets, sort of seeking that product market fit, and they've got a few irons in the fire. Then later on, you've zoomed in on 1 or 2 or 3, hopefully, markets that you're serving. And then later on, you expand and sort of diversify again. So I think of this as sort of a butterfly, where you're sort of broad, then you're narrow, then you're broad. Not everyone does this, but it's a pretty typical path to success. If you're in that early phase, then you've still got options, right? You haven't picked your bets yet. So I would think a lot about segmentation. So I was talking to one of my clients about this last week. Every recession is different, right? So 2000 was driven by telecom, then dot-com bust. 2008, obviously driven by banking and finance. This one, sort of driven by pandemic, right? So the lessons are different every time. But I think one common theme is not every sector is hit equally at the same time. So first thing I would say is if you're in the early part of that process where you've still got lots of bets in lots of industries, then segment your customers, right? Seek 2 or 3 tranches. Sort of, we've got a few customers that are in the hotel space, right? They are just zeroed out. Then we've got a few customers that are in the, I'm trying to think of a random space, construction space. It's probably affected, but unclear yet. And the third is maybe we've got some customers in the medical space, right, which has got its own set of issues. So I would take a probably more sophisticated approach than I would ordinarily take at that stage in the sales process of the company evolution, which is to say, try to segment and tranche your customers or prospects, and then come up with 2 or 3 different approaches. And one of them, for some companies that are in crisis, well, let me take it a step back. So I would think about what's going on in 2 phases. There's the short run, which is the pandemic, and there's the long run, which is the recession that's going to follow. So separate those 2, because there are companies that are responding to the pandemic that requires a certain time. If you're in healthcare right now, you are seeking very specific solutions to very specific problems, and you just don't have time to talk to anybody else. That won't be true for 6 months, hopefully, but it'll be true for a few months. So that's the second variable I would use, which is think about the time frame. The short run is pandemic driven. The long run is recession driven. And those might be two different strategies based on those different industries that you're looking at. So again, no answer, more of a framework to think about it.
Can you just say a little bit more about the sort of pandemic-driven versus recession-driven, and how you think about that?
Yeah, so there's a period here in the short run where everything's just going to stop, and this is I'm thinking back to both 2008 and 2000. There's a period where everything just sort of freezes because no one knows what's going on, and then gradually a new reality emerges. And that recession can last a while, right? In 2008, it lasted a shocking long time. It was a year or something, a year or two. It was a very long recession. The previous two that I lived through were each about, I went and looked it up, they're each about 9 months. So the 2000 recession lasted about 9 months. And remember, recession is different from unemployment, is different from stock market, right? Recession is a quarter with negative growth, GDP growth. So the 2000 recession and the one before it, which was 1990, I think, which I was in college for, were both about 3/4 long. And during that period, economic activity just slows down, but life is continuing, right? People are going to their jobs, people are doing work, they're just doing less of it. So most of my experience and people who have lived through these things, I have a lot of recession experience. I don't have any pandemic experience. So the pandemic, the sort of near-term phase is likely, I'm guessing, based on what I'm saying, is, some industries are just going to shut down, right? Hotels, travel, it's just shutting down. So trying to sell into those industries right now, if the ship is on fire, and if you are, if you're not selling fire extinguishers, no one's going to buy anything for a period of time, which I know is very contrary to the, you can do it, we'll survive. Like, there's a period of like, hey, just recognize, like, people are dying, people are getting sick, like, your sales process is not on anyone's mind right now. As we emerge from that into the recession, then that's more of a, like, recessions happen, right? About every decade, recessions happen. So you can adapt to that, you can sell into that, you'll need to adapt your strategy. But don't confuse those two, because the strategies that you develop for the pandemic, which I'll talk about in a second, are probably different from the recession strategies. So let's talk about pandemic strategies. And this touches a couple others. Kind of what can we do in the short run? So again, it's segment based on the industry you're selling into. But the advice I'm giving people is, chill out's the wrong word because no one's chilling out, but recognize that in the short term, sales in certain industries are just going to stop, and being a pain to people is not going to help you, right? So the hard sell is not the right answer in the short run. So let me caveat that by saying, if you have deals that are about to close in industries that are not getting crushed, then I would rush to close those, right? Because again, the pandemic's going to be followed by the recession. So if you've got deals on the 5-yard line in an industry like, finance or manufacturing, that are not sort of directly getting crushed by the pandemic, I would push hard to close those. And I would do things I would not ordinarily do. I would discount, for example. I would look for, and I would look for extra services. I would throw things on in an effort to get those closed, because things are going to get locked down, right, post this pandemic. So I would rush to close those. What I would not do is put on the hard sell to people that are not responding. Because if they're not responding, it's maybe because, their spouse is sick, or their house is locked down, their kids are people's lives are a mess right now. So I'd be really careful about the hard pressure sell. And that's sort of in the pandemic mode. If you're selling into one of the affected industries, then I would look for ways to be helpful without selling, because no one's buying. Again, if you're selling face masks or 3D printing, there are things people are buying. If you're not one of those things, I would look for ways I would focus on building the brand. So I would take resources probably away from the direct sales and think about how could I apply those resources into ways to be helpful to my customer, like genuinely helpful, right? Not like download a white paper, but my product's so awesome, but actually helpful. Doing things that are relevant to your brand, but maybe not directly on brand. Maybe it's a free tool that takes advantage of your underlying technology, but solves a slightly different problem than the one that your core product does. But I would think about diverting resources that will not be well used on the direct sales process for those industries, and putting them into doing things to help. And I've seen a ton of examples of that. Even Zoom, right? The company we're working on has put a bunch of resources into COVID response and educational resources and stuff like that. Now, of course, Zoom is flourishing, but I would think about that sort of thing. What can I do with my resources to be helpful in this phase so that when we emerge from the short term, the pandemic phase, into the recession phase, I've built the brand, I've maintained relationships, and I may have built assets that are not wasted, but they're useful ongoing. I probably wouldn't have prioritized them under normal conditions, but rather than sort of squander those resources, trying to build funnel in a time when no one's answering the phone. Those are some thoughts I would have about that trade-off.
Can you maybe touch a bit more on, for customers that are pretty deep into the funnel that you're going to be frantically trying to close if you can?
Yeah.
What are some of the levers that you'd be pulling? What are things you normally wouldn't do that you would do, and why? And then I know we talked a little bit about this previously, or it was in some of the notes that we had, but how do you have a realistic view of how far in the funnel you actually are, so that you don't just like blow all your bullets on folks who really aren't great prospects?
Yeah, this is why I say, first of all, don't be a jerk, right? There's a great book by David Meerman Scott about newsjacking, which is a marketing technique, right? Of getting sort of jumping on news and being part of a news story. And one of the points he makes is like, hey, tragedies are really bad things to newsjack, because it's really easy to miss the tone and come across as a jerk. And I would say that applies to sales in this environment too, right? Calling someone up and saying, trying to tie the closing of your deal to the pandemic crisis is probably a bad idea, right? And it's probably going to not close the deal, and you're going to look like a jerk. And looking like a jerk lasts a long time. So that's one thing I would say. Be real careful about high pressure sales. I would say if you are on that sort of 5-yard line, and it depends what kind of market you're in, right? If it's SMB and short sales cycles versus enterprise and long sales cycles, like it's hard to sort of give a general rule of how to tell. But if you are at the 5-yard line, then can you get a hold of your champion, right? And if you get a hold of your champion, I would try to have an honest conversation, sort of a human conversation about what's going on. Understand their environment, understand their company. And I would not ordinarily do this, right? Usually at the 5-yard line, I don't want to stop and have a discussion about what your CEO is doing right now, right? I want to close this thing and not bring up distractions. In this situation, I would probably try to understand the context this person is operating in, right? Is the company struggling? Have they had a massive layoff? Is their supply chain collapsing? Are they seeing increased demand for something? To get some context about what's going on in the company, and specifically your champion's life, right? Your champion is the person who's going to push this deal through and get it done. What is their job? How has it changed in the last week, 2 weeks, 3 weeks? How is it changing over the next couple of weeks? So I would try to get that context. And I think that's how you get the picture of whether this is going to happen. Because you can tie back, hopefully you've gone back, and again, I'm going to speak from the enterprise sales perspective a little bit. You've gone back to those early calls you had where you established the need, tied that need to some sort of corporate goal or company goal or KPI, some sort of bigger picture. And now you can check and see if that big picture has changed or not. If it's the same, great, you keep pushing on the same, your story hasn't changed, right? Whatever that value prop was, whatever that ROI was, that's it, keep going. If it's changed, then you step back and you say, well, can I tie my product or my service to that new value prop? Can I develop a new value prop based on the changing business conditions this person just described to me? Or can I not, right? And if I cannot, then step back, look for a way to be helpful, don't burn that relationship, preserve that relationship through the pandemic, and think about how I can come back to this person 2 months, 3 months, 4 months from now and try to restart that sales, right? Don't have them write you off because you push too hard. If you can build a value prop to that new world they're living in, then this is your chance, right? Turn it around, be flexible, demonstrate the things that big companies or companies love about buying from startups, right? Which is they're flexible and agile. Demonstrate agility, right? Change the features, change the positioning, change the pricing, change the onboarding, whatever it is you need to do to make it fit the new business world this person's operating in. But again, don't guess, right? Have that conversation, have that human connection so you actually understand what's happening in this company.
There are a couple of questions on pricing. How would you be thinking about, there's either the pandemic stage or the recession stage, right? There's going to be some sense of, depressed demand.
Yeah.
Do you start to get really aggressive with pricing across the board, or do you just approach your pricing strategy differently in this context?
Yeah, so I would think in the short run, So it's unlikely if things are in crisis, a 10% discount is not going to change things, right? Let's just be realistic, right? So I think in the short, so like many people, I'm not a big fan of discounting. You know, my experience is most startups charge too little, and there's some selection bias to that, right? If you charge too much, you don't make it. So sort of by definition, the survivors tend to charge too little, which is fine. It gives you opportunity to raise price. And I also think that discounting is a drug. That once you start discounting, you've trained your sales force, you've built a culture, and you get to the end of quarter or end of month, whatever it is, uncertainty. So it's a path-dependent path, right? You go down that path, it's hard to come back. Having said all that, if you find yourself in a situation where you could close something short-term with a discount, then I would give it a try in a way that, again, I would not ordinarily be as flexible about that, but today I probably would. Once you've established the things I've described already, right? Step one is not, hey, how about 10% off? Will that do it? Step one is, hey, what's going on? Let's step back. Let's understand the context. Oh, it sounds like, you know, your budget's being cut. Everything else has stayed the same. You're seeing the same objectives, but less money. Would a 10% discount help? Would that get it done by Friday? You know, have that conversation. But I would only do it under those conditions where you have some indication that price is the factor. And it rarely is. And as we go into the recession, the observation I have from the 2 recessions I've seen in the past is it's not usually a discounting problem. It's usually a prioritization problem. So my first startup, Free Markets, we sold e-sourcing. We helped big companies buy stuff over the internet, kind of back before the internet was a thing. And we started, I joined in 96, company started in 95. And you know, I don't know how many of you lived through the dot-com bubble, but it was an experience. And we were not unaware of the frothiness, right? But we were convinced, we used to tell people, you know, when the recession comes, we're counter-cyclical, right? We help big manufacturers save money on their direct materials. What could be more counter-cyclical than that? Well, it turns out we were wrong. It turns out everybody's wrong. Startups are not counter-cyclical. There's probably some exceptions to that, but the vast majority of the ones that I've seen who thought they were counter-cyclical were not. And the reason is that mostly what happens is buyers stop buying new stuff. And what your value prop is less important than whether they bought you last year or not, right? The budget's getting cut by 30%. I look at the budget last year, what's the 30% I can cut? And if you weren't in that budget last year, I'm sure as heck not gonna add you. I'm not even gonna evaluate you because I don't have room to add anything. It doesn't matter what your value prop is. I don't have the time to watch your demo and do your ROI and understand your onboarding process. It's just not worth it because I don't have any money. So that's sort of one theme I saw from the 2 recessions that I went through was don't fool yourself that your product, because it saves money or for somebody, is a counter-cyclical product. Now, I don't want to be doom and gloom. Product still got sold, right? Free Markets still, we were probably $110 million. Not really a startup at that point, but you know, we're only 6 years old. We still sold, right? With the company, I think it was flat till down a little bit, which of course, when you're growing 20, 30% a year, right? You know, flat feels like death. The reality is it's not death. You just get through it and you plan your cash, you plan your burn, you plan your growth accordingly. But if you continue to just think, hey, we're going to grow 30% this year because we are, you know, we're going to help all these companies who want to save money, that's probably a mistake. And again, there are probably exceptions to that, but not as many as people think there are. So I've sort of wandered all over the place on that.
No, it's okay. How do you think about? I mean, this is a tough question, and it wasn't one that was submitted, but it's certainly one that I think a lot about. You know, for folks here who are running their own company or they're leading a team in sales and marketing, how do you think about reorienting your budgets and staffing during this time? You know, given the fact that there is a with the pandemic recession, you know, component, like there will be a time on the other end where presumably demand returns to some degree, but you may have a very short-term period of just like little to no activity. So how does one think about, you know, what is the right allocation of resources?
Yeah, so one is you got to manage your sales team really carefully because salespeople hate not selling stuff. And there's going to be a period here where they don't sell stuff, right? Certainly the pandemic and maybe part of the recession. So there's a little bit of, you don't want to take the foot off the gas. Oh, it doesn't matter, quotas are reduced this year, everyone's going to be fine. That's probably the wrong approach. But flogging the horses when, my metaphor is going to fall apart here, when the track is muddy, I'm not a horse racer, is not the right answer. So I would think, first of all, take a good hard look at your sales comp model, which drives sales behavior. And second thing I think about is if you are further along and you have existing customers, then I would spend a whole lot of time thinking about those customers. Because this is always true that it's easier to retain a customer than win one, but it is far more true during a recession period. So you may not have had a churn problem last year. You're going to have a churn problem next year because a whole lot of contracts are going to get reevaluated, and anything that's on the margin is going to get cut. So I would take some of that outbound effort, and it may be tasking an account executive who has the interest and skills. Maybe you don't need as many AEs this next 6 to 12 months. So maybe 1 or 2 of them are interested in being account managers. And you focus them on retention and growth in your existing accounts that have seen success. Remember what I said a minute ago. Were you in the budget last year? If you were in the budget last year, you better keep that account. So putting heavy resources, good people who are interested and sort of understand the mission against retention, which, by the way, most account executives are not naturally wired for, right? Most account executives are go out and kill the elephant or kill the gazelle. Again, I've got animal metaphors, and then keep moving, right? So making sure, and they don't naturally sort of pivot to the nurture, which is about keeping spreadsheets and staying in touch and asking lots of questions and following up a lot, right? Like making sure stuff gets done. That's not necessarily the classic account exec personality. So looking at your team and figuring out who on this team can I pivot into an account manager role and task them with retention and churn reduction would be a great way of preserving what you've got and growing those accounts where you've got the best shot at incremental dollars. And on the marketing side, same thing. I would think about allocating maybe money away from outbound, which you'll see the effectiveness drop. Whatever your ROI on outbound was 6 months ago, it's going to be a lot lower next 6 months. So I might think about reallocating those dollars away from, cold calling or lead gen or whatever it was you were doing, and allocating them towards asset building. Because during this period, you can build assets that you can use for a long time. And assets might be documentation, it might be white papers, it might be videos or demos or free tools or things that are probably not the highest thing you were thinking about 6 months ago, but given the effectiveness of a marginal dollar spent on outbound over the next couple of months is going to be low, then I would reallocate to what are assets that I can build that will prove to sort of bear fruit 6, 12, 18 months from now. And that, again, technically is on the marketing side.
So this is a question also was not submitted, but and I'll buy you some time to think about it if you don't have an answer right away. Are there any things that you're seeing with either your consulting clients or other companies that are like gut reaction, logical things that founders or execs do that are just mistakes at this time?
I have, so to be fair, I've probably only interacted with a half dozen companies in any depth in the last 2 weeks. So my sample size is not that big. Mm-hmm. I think the 2 things I'm seeing, so one was missing the behavior change that was coming. So I'm thinking about probably a month ago, maybe more than a month ago, one of my clients is it's a field sales driven organization, right? People go out and visit, they call on the clients and they do a lot of trade shows. And it's hard to think about when it was, right? It feels like it was 6 months ago, but it was probably a month. And we had a conversation about thinking about digitizing, there we go, the field sales process. And that's not how that industry worked. That industry worked with field sales. That's how it was done. It was the right answer, right? That's how buyers expected to buy. But we sort of looked ahead and said, hey, look, 3 months from now, my guess is your field reps are not going to be welcome calling on people, right? They're not welcome in the building. So what can you do now to adapt? And there was a little bit, I'm not sure how quickly they got it. I mean, they're doing it now. So that was one. The other thing I think I've talked to people about is the hiring. So if you were lucky enough, so one of the companies I invested in, a bunch of companies I invested in were raising money 3 months ago. And I think all of them made it, right? There's sort of that window there where, right, if you got it done, if you got the check a month ago, you're in the best possible position, right? Because you got the capital, now you have a chance to look ahead, reduce your burn, roll it out, and it's going to be hard for anybody else to get funded in the next few months. So I think these guys pulled it off. Great timing. And he pinged me the other day and said, hey, I'm having a really hard time finding machine learning people. Do you know anybody I can hire? I said, listen, slow down because we're going to see a huge set of layoffs. It's just starting to happen. So slow down your hiring for 2 reasons. One, you need to spread the burnout a little, right? So you've got about 1.5 years. You really want to have a couple of years. That's the advice everybody's giving, right? Maintain the cash, slow your burn. Mm-hmm. But also tactically, the talent has been a constraint for the last couple of years. right? To everybody. Everyone's trying, especially machine learning or AI, developer talent. That is going to stop being a constraint here. This is the good news. The silver lining of a recession is if you survive, your key constraint gets relaxed. So my advice to this guy who's fairly young, hadn't lived through a recession before, I said, listen, slow down, raise your bar, and hire these roles more slowly. Because the talent you see come on the market over the next couple months is going to be astounding. Really good people are going to get laid off. Because it's not about, when times are good and people get laid off, well, you're never really sure what happened there. But when industries collapse, everybody gets laid off. So, the best companies, the best people at the best companies are going to be on the market pretty soon. Not all of them, obviously. I'm not that bad. But you'll see a lot of people come on the market that you couldn't have gotten 6 months ago. So slow down, take a breath, and raise your bar on the hiring and find some really great people. And if it takes an extra month or two, that's fine, because you need to slow your burn down as well.
Yeah. And before we transition to sort of open Q&A, there were a bunch of questions that were directed toward around fundraising. And so I'm just going to make a couple comments there, and then we'll open it up more broadly. So, the basic question is something like, are VCs actually open for business? How do you approach fundraising during this time period? What's going on? So, my general view here is over the last few weeks, and I think we're more or less coming out of that period, if you were not deep in a VC's pipeline, nothing was going to get done. If you were deep in a VC's pipeline and they had capital, they probably closed. Like if you follow on Twitter, right? Like there have been a number of cases where deals have blown up or VCs have walked away from term sheets, but that tends to happen an extraordinarily limited number of times, if at all. And so, that probably happened. But every investor over the last month has been in triage mode, and they're putting, they're kind of bucketing their portfolio into one of three buckets. Bucket one is great cash position, doing fine, I don't need to worry about you. Bucket two is really in trouble, may or may not be able to make it. And so again, I'm not going to be able to make much of a difference. Therefore, it's not a huge time commitment. And then the third is, could go either way. And so it's really worth one's time to help manage the situation closely with the founders. And so I think every VC over the last month has been focusing on that third bucket, and that's really absorbed them. There's only so much that VCs can do. Like, we're not really like operating companies. And so, after a month of intense effort around this, you start to have some additional bandwidth. And again, assuming that you do have capital, and most VCs, I'd say, at least half the industry has capital, if not more, you go back to your day job. Every VC also knows theoretically that the best time to invest in something is when markets are in transition or uncertainty, because that's often when some of the most exciting early stage investments happen. But we're also humans, and we're driven by fear and uncertainty. And so I tweeted this right before I got on this call. I think in a strong market, VCs are driven by FOMO, fear of missing out. In a weak market or choppy markets, they tend to be driven by FOLD, fear of looking dumb. And so even if we say that we're in business and we're going to be just as aggressive as we were in the past, I think they are going to take longer. It's going to be harder for VCs to make the leap to get there in something that isn't like terribly linear. And it'll take longer to build trust and conviction with an investor. And so, I think deals will still happen. I think it'll take longer. Pricing won't be as rich, but I'm reasonably confident that that investments will continue to happen. And so if folks have more questions there, I'm happy to go into more detail, but that's my quick overview.
So like I said in the chat, if you have a question, you can go ahead and raise your hand, and I'll let you know if you can unmute yourself. But there are some questions coming through in the chat, Rob, go, that are around the VC funding situation. If you want to take a look.
Yeah, I'll try to touch on these, and Rob's, you feel free to chime in too as an angel and somebody who's raised VC money. Let's see. How is the approach different for angels versus VCs during the crisis? I would argue that most VCs will be more capital rich compared to most angels, because angels are, typically investing out of excess or out of, their own wealth, and VC is like, we have committed capital from our LPs, and it's not like that amount of committed capital goes up or goes down depending on the market situation. Assuming that the capital will be there and that'll be the case for the most part. So I do think that VCs will have relatively more capital than angels, but typically I find that most angels aren't writing huge checks, and so the value of an angel check is more about like a stamp of credibility and their time and effort. And so if you have an angel investor that was going to do 25, 50K and they can only do 10 to 15K, I think the value of their involvement is still going to be pretty high. And so I still would approach angels. I just wouldn't expect as much money from them. Yeah.
I'll comment on that. So I mean, I'm looking at 2 angel deals right now. I do kind of 1 or 2 angel investments a year, so I'm not a big angel investor. And you feel less wealthy, right? I mean, as you walk, your wealth would go down 20 to 30%. It affects your willingness to put money into things that are, this asset class. But the process doesn't change very much. So the companies I'm talking to are companies that I'm interested in, right? I know the founders, I've spent some time getting to know them, I'm interested in the topic. So I think for that class of angel investor, it probably won't change very much. And there's a second class of angel investor, which has really sprung up in the last 4 or 5 years, which is the more want to be like a VC, right? The syndicates, I'm putting money in because I think this is a good investment, not because I know you, right? I want to invest as like a VC. I think that will dry up because I think it's more of a financial driven process, versus the more traditional angel, again, the category I put myself in, it tends to be as much about giving back and being involved and being interested and liking the topic. And that those things are less affected by the financial market behavior.
This question about what markets would VCs be looking to invest in during this time. I think this is a little bit less pandemic driven. I think we was already starting to see a trend even before this happened, where you saw you basically saw in the public markets pure software businesses getting really rewarded, and anything that wasn't a pure software business get punished, even if they got to significant scale. So you think about the WeWorks of the world, the commerce companies, things that have like a heavy logistics component versus pure software businesses. And so I think you were seeing, and I think if you look historically at the VC industry, during very bullish markets, VCs tend to stray from their from the roots, I guess, which is, invest in companies that are mostly technology and software driven, that have very high margins and can potentially be really large scale companies. And they start to invest in things that are maybe lower margins or have less defensibility, less technology leverage. And then in weak markets, they tend to go back to like, okay, what's a great looking software driven business or technology driven business? So I think that's where you're going to start to see, like, as trends go. So I think that's what you're going to see.
There was a question that was sent to me. Is there any evidence that some prospective customers are using this downtime to consider strategic investments in new systems? In other words, might they be more available to evaluate a new system than they would be otherwise?
So I'll comment. There are probably examples, right? This is one where like it's very hard to make blanket statements. My experience, however, has been those are very rare. So if it's true, you should jump all over it, right? If there's something about a particular deal in a particular industry and a particular buyer that the story makes sense, right? Like this is why that person is buying now. Again, is it COVID related? Is it countercyclical? Whatever. I would jump on it. But my experience has been most people historically, including myself, have fooled myself that there's some reason why this deal is going to go forward, even though the industry that person's in is in shambles. So I think I would be very cautious. Having said that, you've got to work on something, right? So it's about picking the best deals and working on them. So it doesn't mean stop working on them. It just means probably be realistic about why would this one be different. And then I guess the flip side of this, find reasons to make it different, right? This is the proactive side, which is you're a startup, you have flexibility that incumbents don't. Do something different, right? Adapt your pricing model, adapt your product, figure out what would make it happen. And then if it doesn't make this deal happen, maybe it takes 3 months, but make it happen, right? Make those changes and flex to the situation. Because that is really the advantage that a startup has over incumbents in most of these markets. They can adapt. Startups can change their business, they can change the pricing, they can change the features in a way that the incumbent just can't do.
So there's a question on pre-seed seed companies that are in effective segments. It'll be more difficult to show traction. How do you evaluate a startup like that? I think practically speaking, if you're in a heavily impacted market at this point, it isn't that useful to be actively pitching VCs. I'd actually think about this similar to Rob's advice around starting a sales process, right? Like, it's not terribly practical to try to like drive towards, try to get a VC to drive towards like a yes or no decision during this time. I do think it potentially is practical to start to kind of build brand and, kind of build awareness about your offering and why, for whatever reason, when things turn around, like the market need for what you're offering may be better than ever, such that the investor's mentally primed for, when things do turn around. All they need is like a month or two of positive data to be like, okay, like I was mentally prepared to like see this happen and it's happening. And so like, I'm really ready to make an investment now, or engage in a deeper way. So, but, I think that if you're a hospitality or a travel related company, even though, our time horizon's long, like it is tough to get an investor to say yes right now. That said, like, I think that investors are taking meetings, and they are aware that the process is going to take longer than it normally would. And so, whereas typically in this fundraising process, like you have the sense that if it's been dragging on too long, there's something wrong, or there isn't that much heat around a deal. I think right now there's a little bit more tolerance for that, and the benefit is you get to know a founder and watch them kind of operate and manage their sales process with you over time. So there's more tolerance for that now.
What marketplaces go to pre-recession? So the question is, many marketplaces grew out of the previous recession. Where do you see the next P2P marketplaces emerging from during this upcoming recession? If I knew that, I'd be spending more time investing. I think this gets to a broad topic, which is every recession is different, right? The first one I lived through was driven by the dark fiber problem that led to the .com problem that they blew up. Then 2008 was driven by the financial markets blowing up. And then this one is obviously driven by COVID. So I think trying to predict what's going to happen in terms of specifics is a very risky game. And some will guess, and some will guess right, and some will guess wrong. I think it's just luck. I'd be very surprised if people are able to, at this stage, guess what the outcomes will be of a societal change. I think we're going to see massive societal change. I think predicting what that societal change will be is extremely hard to do. So I'm not a VC partly, so I sort of bet on one horse at a time for the most part. But I'd be very skeptical. I'm reading all the Medium posts and I'm reading the blog posts and the LinkedIn posts about people making predictions. And it's fascinating, right? I think we're so early in this. It's so hard to predict what behavior change will be coming out of it. It's unlikely you're going to right.
I think it may be tricky to pick like, oh, here's a marketplace that is going to be, blown open because of this. I think that you can anticipate some level of behavior change, or at least, you can make a point of view that the attitudes of end users or, folks who are, potential business decision makers are going to change in certain markets. So a couple examples would be education, right? Like every educational institution has had to deal with digital, kind of ramping up the digital component of their learning and the video component of their learning. And coming out of this, I think both end users and decision makers are going to have a different point of view, and that may present an opportunity. Telehealth, I think, is going to be really interesting. And part of it is a lot of regulations have been rolled back to deal with a pandemic. And when things get back to normal, you have to imagine that not everything that was rolled back will be like reintroduced, and you're going to have both providers and patients who have some level more comfort engaging with the medical world through tech products. So I think that's going to be an interesting area to watch. Those are both like relatively obvious, I guess, but you know, that's how I think about it, right? Like, what are some things or industries that are being forced to have a reckoning with technology that's been holding it off, that's been resisting it for a while, and you know, there's likely going to be some change in their attitudes towards technology coming out of this.
Rob, that made me think of one of the questions we got beforehand that I wanted to touch on was the innovation team's question.
Yeah.
Not directly related, but similar. So one of the big changes we've seen over the last decade is lots of bigger companies have introduced the idea of innovation teams who act as sort of scouts that go out and meet with startups and acquire and sort of shepherd that startup through the buying process for the company. And I would say on the sales, so a lot of startups I work with, that's who they're selling to. And my advice to people has been, be careful about that. Get out of the innovation group as fast as you can. Find your real buyer, because the innovation team's job is to sort of find cool stuff, and you need to find the person who actually their job is changed because of the product you offer that company. I would say I'll make a prediction, that's why I made me think of this, is that I think a lot of innovation teams are going to go away fairly quickly in the recession. They're going to be among the first to get cut. So if you're selling primarily to innovation teams, I think you need to refocus your sales funnel and find people where you are selling to the actual buyer, where the gatekeeper, the introduction, the scout, the innovation team people, I would break my dependence on them as fast as possible. Because I think when big companies in these affected industries start to cut people, the innovation team will be very high in the list of people to get cut. I just want to make that comment. Other questions?
There's a question around innovation. Just building relationships with me specifically, or with investors during this time. And I think, you know, if you're not pitching, you know, how do you build a relationship? How do you show value? What do investors value? And this is true for me, and I think it's probably true for a lot of investors, is, you know, our knowledge base is like an inch deep and a mile wide. And we can't necessarily get that deep, but we love learning about new problems and new industries. And so I think the most productive type of like relationship building and kind of value add to VC is exposing us to problems that we maybe were not aware of before, trends in the market that are not that obvious, and getting us to just like, you know, when you're not pitching, at least walk away from a conversation saying, like, I'm going to start looking out for this in my day-to-day life, or when I talk to companies. And as I hear this problem kind of resurface several times over the next couple of months, I'll remember that I heard that originally from you. And, you know, when you come back and start pitching me a solution to that problem, it's going to be fresh and somewhat top of mind. So I kind of approach it that way, right? Like, it's sort of like Peter Thiel's concept around, you know, does your company have a secret? I think, you know, kind of exposing the secret to investors and letting that marinate over a period of time is a way to, you know, kind of softly, you know, keep the sales process with them alive until, you know, it's really time to hit them more directly.
Well, and I'll translate that back to the go-to-market side, which is the same exact approach, right? The idea of content marketing that has really grown is this idea of being helpful to your customer and doing the job that is similar to the job that your product solves. It's a little bit convoluted way of saying it, but be useful, right? Earn the right to have a conversation. And I made references early on about what can you do when these sales processes get stuck? What can you do in the short-term period where so no one's buying anything? And it's the same idea, right? Be useful, be educational, be helpful. I was thinking at one point about whether you could you build a free tool, you know, that would solve something similar to what you're working on that is more valuable now than it would have been 3 months ago because the world has changed, right? So treating investors and as well as customers as somebody that you're going to build a dialogue with, you're going to build a relationship with, and you have something to offer aside from the product that you're selling. I think customers will respond the same way, right? You'll earn the right to come back to them a few months from now and have a different conversation.
Rob, are there any examples that you can think of, either recently or, you know, even in the somewhat recent past, of companies that have really brought something to life that that was really, really helpful to the market and complementary to their sales?
Well, the one that's jumping out right now is this is very short term. Is the 3D printing companies are doing amazing things directly on COVID. Right now, this is because they happen to be directly in a space, and I'm sort of I'm a little bit involved in the 3D printing world. One of my companies is bought by Stratasys, so I'm aware of this. But my sister's is in supply chain at a hospital chain in Southern Connecticut, and she reached out to me last week. I started saying, "Hey, let me know if there's anything I can do." And they wanted to 3D print bands for face masks, so not masks but shields. And so I started digging into the 3D printing world, and the 3D printing companies are really investing in this. They are putting resources against it. Now, this is almost a humanitarian move, right? They are actually helping the medical profession directly, but they're also generating knowledge, and they're putting out open sourcing designs, and they're putting networks together. And so, they may not be making any money off this. They're probably not gaining customers. Hospitals are not going to buy their stuff long term. But to put on a sort of cynical business face on it, they're building great brand equity, right? They're building both the knowledge of industries they would probably like to be in, right? They're learning a lot about the medical space, but they're also building great equity among potential employees. I mean, I'm aware of it, right? My opinion of them has changed because I see what they're doing and the investments they're making. And again, that's an extreme example. It's very short term, but I think about things like that where you can actually help in a way that may or may not be economically rewarding to you in the short run. Now, you should go to business, right? You're a business, not a charity, so you can't afford to sort of give all your money away to solve the problem. But I look for ways where, what can you do that would be actually helpful and visibly helpful in a way that sort of supports your brand and builds a relationship with people you might want to talk to later.
Yeah, one company that I've been aware of is a company called ESL Works. It's a startup in New York that focuses on training for sort of starting initially in sort of service workforces, initially focused on English language training. And a lot of their customers are restaurants, and so that obviously is not great. But one of the things that I've seen them do is they've essentially rolled out a free version of their platform to be used specifically for kind of COVID-19 preparedness training for any takeout restaurant that is still serving takeout customers. There's a whole new set of protocols that they need to be able to push out, and so they've done a really good job trying to be the platform of choice for any company that's needs to push out that training really quickly. And I think it's a really, really smart bet because when you go from this isn't going to just turn off right away, right? There's going to be an in-between phase where life kind of goes back to normal, but there's going to be a much more heightened sense of kind of concern and higher standards of sort of sanitation preparedness. And so they'll, I think presumably be in a good position to start conversations with customers when that happens because of what they've done early on. So I thought that was a good example that I've seen recently.
I'd also add the cultural side of it. So we had a preview question around sort of culture and the organization. And I would say doing the right thing as a culture is the right thing for your employees, right? Your employees are people, your prospective employees are people. And to the extent in which you sort of put the business objective, if you can, put the business objective sort of a little bit to one side. I mean, you have to survive, right? But putting that to one side a little bit, doing things to sort of chip in and help out and help people, it makes employees feel good about what they're doing and how, startups are all about changing the world and making a dent in the universe. We have this very noble sounding purpose, but, some of us are out there, I was part of a company that we ran auctions to help big companies buy gaskets cheaper, right? That's not, we weren't curing cancer, but to the extent to which you can actually show how your work impacts humans, and this is an example in a crisis when you can do that, then you can remind the employees internally about why they're there, and you can give them more reasons to be there. And the companies that do this well in a crisis, and it could be a recession or anything else, they build a team that believes. And I saw this in the companies I was in the 2000 crisis, and the company I was at in Kiva, right? The people that went through that capital recession, the 2008 recession, we were tighter, right? We'd survived something together, and we did the right things, and we behaved properly, and we took tough decisions. But that sense of it forged the team a little tighter. So I think there's an opportunity there, again, separate from the financial considerations, but on the cultural and the sort of organizational side, to do the right thing and reinforce that culture and sort of walk the walk that you've been talking about of, we're making a dent in the universe. Other questions? Rob, a lot of people want to talk about fundraising. That's really surprising. I didn't anticipate that. Who's trying to sell stuff to people? Anybody? Some of you should be selling stuff. Let me urge you to sell stuff to people. It's a good thing.
Well, you're saying, don't try to oversell right now. So
it's
if
true.
you're going to burn a couple months, you need some capital to do
That's true. We'll spend those months pestering the VCs. That'll work out well. I'll talk briefly about on the hiring competition topic that came up to someone else as well. So there was a question we got in the preview was around what will happen post-recession. And so some of you are in spaces where competition is a problem, right? So some startups typically fall into one or two buckets. Either we're inventing something new and no one else is doing it. That's kind of rare. And your problem is explaining to the world what it is and why the heck they should care. Or you're in a space that is sort of people understand, you got to explain why you're different from other people, right? Sort of why, at Backupify, we talk about why backup, why Backupify, why now? Those are being the three questions we answer in a sales cycle. So if you're in category 2, which is there are other people doing this, mine is better. Well, the good news for you is not everyone's going to survive the recession. So your competitive landscape is going to change dramatically. So if you are in that bucket where you've raised capital relatively recently, then I would think strategically, think about strategic game, the multi-layer, the multi-step game of who are your competitors. Again, in general, it's not great to spend your time focused on competitors, but this is a moment where I would take a minute and look around and say, hey, our biggest problem has been it's a noisy space, right? There's these 3 companies making the same claim we're making. I would take a minute to figure out when was the last time they raised capital? And if it was 18 months ago or 12 months ago, then you could probably make some guesses about what their behavior will be over the next few months. And you could probably do things, but so for example, we just lost this account to this other company, and boy, that company hasn't raised money in 12 or 18 months, and if they look like they have a big burn rate, I might go call that buyer and find out, how far down the path are they? And I would never be in a situation where I'd be bad-mouthing a competitor that looks you look bad, but I would probably chase deals with competitors that I believe to be financially weak. And the flip side is, to the extent to which you've raised capital or you've got a strong balance sheet, I would talk about that, which is not usually something I would do. But I think specifically people who are tech sophisticated buyers, which more and more people are now, they're aware of kind of how startup funding works. And so if there's been debate over the last few months, everyone's raising capital all the time, it's not a really big deal anymore, everyone's fully funded. That's not really going to be true over the next 6 months. So if you've raised money, I think sending signals of stability to the market, your potential customers and your potential employees could be very valuable. Rob asks, are any of the companies you're advising consulting participate in the CARES Act? I have no idea. The CARES Act just came out. I actually haven't really figured out how it impacts anybody. No one's talked to me about it. Sorry, I don't know the answer. You sell a customer retail experience. Oh yes, this is a good question. So we sell a customer experience platform to brick and mortar retailers. We're positioning to help retail teams when stores restart. Now is certainly not the time to talk to retailers, probably true. When should we think about pitching them for the restart? I would think about milestones, right? So rather than try to guess each day, each week, I would try to think of what are the KPIs in this industry that are externally observable that your customers are also looking at. I don't know enough about it to guess what those would be. But then I would track some of them, and I would try to be intelligent about them, and I would use them to start the dialogue. So it might be, I'm going to think, I'll have to dig out. I used to sell to retailers. Let me think for a second what I might use. Yeah, I can't think of anything. I would try to look at, hopefully you're deeper in it than I am right now, but I would try to look for third-party observable numbers. And for example, when this number ticks up by 10%, I'm going to use that to start a conversation with a bunch of accounts. That way, it's not just you picking up the phone one day. It's you picking up the phone with a reason to call based on some third party, some observable, some news event, something like that. So I would make a little list of sort of observable events. Again, it could be unemployment rates dropping. It could be same store sales for somebody. It could be, I don't know, again, I'm having a hard time thinking of something off the top of my head. But I try to brainstorm with the team on a dozen different metrics I could use that we'll go watch. And then use that as sort of news fodder to, hey, sending out the email, hey, you probably saw the news I saw last week, this good thing happened. a lot of my clients or a lot of my customers are telling me that they're really starting to get back in the game. You know, if you're one of those people, let's have a call next week. But you got to tie it to something. So it's not just you calling them up every day and saying, hey, you ready now? You ready now? You know, you sound like my kids, right? Are we there yet? Are we there yet? You want to have something to point to.
So I want to be cognizant of time. We're coming up on 3 o'clock. So, you know, I think this has been really great. Do you guys have any kind of like parting wisdom, last minute stuff you want people to walk away with?
You can survive this. It's going to feel for some of you like you're not, and honestly, not everyone will. But if you make good, fast decisions and you change the way you do business, you can get through this. And I think we have an ecosystem today. One of the things I've changed each recession is this ecosystem. Today, in 2000, when we hit when we hit a recession, the dot-com happened, there was very little peer-to-peer communication. I was in Pittsburgh, but there was very little peer-to-peer communication. The idea of a startup was still sort of novel. There weren't veterans, right? Everyone was making it up. And I'm exaggerating a little bit, but not by much. Today, there's a lot more peer network. There's a lot more knowledge. There's people out there that have been through it. So I think that gives everyone a chance to sort of avoid making terrible decisions and draw on some of the institutional memory that exists. So I think the chances of survival are better than they've ever been, partly based on that event and people like NextView and others that are organizing events like this to give people a chance to talk. So thanks, Rob, and thanks NextView for organizing this sort of thing.
Yeah, thanks, Rob, for participating. You know, the parting advice I guess I would give is to echo what Rob Stevens said earlier, which is like now's the time to do what startups are good at, which is to be nimble and fast. You know, big companies are going to be hurting. Your big competitors are going to be hurting during this time, and like the level of their slowness is going to be multiplied. And so this could potentially an opportunity to, you know, really get close to your customers and use the pace of, you know, kind of innovation and product development that you're able to have to maybe put some big wins on the board relatively quickly. So, you know, there's some benefits in being a startup. And so I encourage you to make the most of it. But thanks everybody for joining. This is really great. And hopefully you found this useful, and we really appreciate your participation in this.
Yeah, thanks all. Have a good afternoon or rest of your day. Bye.
Thank you. Bye.